Hello and welcome to the i3 podcast. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. There you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice. Please enjoy the show. This podcast was sponsored by ECP. As such, the sponsor may make suggestions for discussion, but final control over the podcast remains with the Investment Innovation Institute. Welcome to the i3 podcast. I'm here today with Damon Callaghan and Sam Byrnes, who are both partners at investment firm ECP. ECP is an asset management firm that invests in Australian and global equities and was originally established by Dr. Manny Pohl of Hyperion asset management fame. But today we're going to look at artificial intelligence and how it might affect Australian listed companies. What are some of the opportunities, some of the dangers, and some of the ethical considerations around AI. So Damon, Sam, welcome to the show.
Thanks for having us, Wouter.
Thank you.
Now, before we start talking about AI, maybe you can give me a little bit of a background in how you got started in investing. Maybe, Damon, we can start with you. How did you get involved?
Yeah, sure, Wouter. So, I'm just go right back to the beginning. I was fascinated by business as a young child. I didn't really know what it meant to be a businessman, but in my mind, I was going to, one day have my own shop front, my own products, and start my own business. And I think it was my father who really played on that interest, and he started telling me that he owned his own businesses. And I was a bit sort of surprised by that because he was a blue collar diesel mechanic, not that I knew what that was at the time. And he told me that he owned shares in a business called Telstra, which I knew of obviously as who we paid for to have our monthly home phone. And, that led to a conversation about the share market. And I still remember him showing me the price graphs at the back of the Sydney Morning Herald on a Sunday morning, where you could see all the big variances in the share prices, and particularly the specky miners where prices had gone up by orders of magnitude. And I remember thinking about, if I could put my pocket money in these sorts of things and understand how this works, that's going to be my path to a pretty exciting future. And so that kicked off an interest when I was really young. That ended up pretty much dictating all the choices that I made around, the subjects that I selected at school and university, and all the sort of non-fiction books I read. Got sucked into that Warren Buffett world and just trying to understand financial markets. And effectively an interest turned into a passion, and I am where I am today because of those beginnings.
Yeah. Do you still hold some of those companies from your youth?
No, mate. My first investments were all money-losing investments, part of the tuition that we all pay as investors.
Yeah, and baptism of fire. And Sam, how did you get involved in investing?
I think my dad also was quite pivotal. I think he was a GM at Bega Cheese. He worked for the same company for 25 years and ended up being CEO of that business until about 2010 when he passed away. And so growing up with him, he'd have the most interesting people coming for dinner. Mum would cook the dinner and we'd have a board member or a customer or a supplier in the house for dinner, and they'd talk business strategy and markets and where they were going to put capital to work. And then Bega obviously being the biggest employer in the town, I ended up working in the factory floor in my holidays and my school holidays. So I got to see where all that capital was going and the kind of the complexities of the supply chain. And so that kind of sparked my interest in business and taught me probably the biggest lesson, which is that I did not want to work in a factory for the rest of my life. So I worked harder at uni and got the marks and went into doing accounting. And then from there, realised I didn't want to be an accountant. I was in Macquarie in a middle office role doing accounting, and my dad wanted me to do the CA, and I was much more interested in investing and going to market. So I took a pay cut into Bell Potter, where that was one of the most amazing experiences, because you had just about every management team in the ASX coming through the doors to present their results to you. So you had everyone from like Marius Kloppers, BHP at the time, down to the small early stage businesses looking to raise capital. So you got to meet interesting people, and they'd talk about their business, what drives those businesses. And you got to understand who was really good at executing and delivering on what they were saying, and who was telling a great story and not actually delivering anything for shareholders. And so all through that time, I was investing my own money, making the same mistakes probably Damon was making, and learning how to become a better investor. And that's what ended up putting me into ECP.
Yeah. So can you describe ECP's approach to investing a little bit? I think you guys are involved with mainly the Australian equity side of things.
Yeah, that's correct, Wilder. I think we just got to go back to our philosophy as a starting point, and then I'll touch on our process. And at ECP, we believe that the economics of a business will drive share price returns over the long term. And what we mean by that is that there is a certain type of business that has the right and the ability to earn a high return on invested capital and reinvest at that return on invested capital. And if it can do so successfully for a very long period of time, it can compound its bottom line at a pretty high rate, and that ultimately will drive the share price. And so, we're looking to find the highest quality businesses that we can possibly find in the ASX. And so that's the philosophy, and how we actually do that is turning that into strategy. And then so our process really bears two parts worth explaining. The first is how we filter the universe down from all the listed companies down to what we think of as investment grade. We're very particular about what we do, so we never start with, is this business cheap? We're exclusively looking for incredible businesses. Businesses, as I said, that can have that high return on invested capital, but can protect it because of competitive advantage, and have the competency of management, the trustworthiness of management to execute. And businesses that don't have the risks that we'd worry about with respect to execution, regulatory competition, and all the like. So once we filter that world down into a really well-refined universe, then we think about part two of our process, which is all around how we allocate capital to our biggest positions and our smallest positions. And the short story there is that's where valuation becomes really important, because we appreciate that we're shareholders taking the prices that are available to us. Some will be priced very compellingly, others less so. And so we always want to have our biggest positions in the most compelling investment opportunities where we see the most upside, and then the smallest positions in those that, is still an acceptable, shareholder return, but is at the lower end. And that's sort of how we build up a concentrated 30-stock portfolio of the best quality businesses, where we're constantly reallocating capital towards our highest returning ideas to optimize the overall portfolio's expected return. And then the last call out really is just how we're different as a firm. I think we're quite different to the traditional fund manager model, which might be described on average as one key star manager with a team of subordinate analysts trying to, hold a 50-stock portfolio. We look very different. We're 6 portfolio managers / analysts that we think of as partners in the firm that are concentrated around one 30-stock portfolio. And, it's a bigger conversation to get into that we're not here to have today, but we think that what that delivers is much more conviction impacting portfolio decisions. And that's something that's missing in the traditional funds management model. And so I think the team strategy and the execution of our own philosophy is, proven now with 12 years together as a firm, stable team, and, compelling returns relative to the benchmarks. And so that's sort of the shortest summary I can give around who we are and what we do.
Yeah. And today we're here to talk about artificial intelligence. And it's sort of interesting because you're looking at Australian equities. And when you think of the Australian equity market, you think of commodities, mining, finance, not necessarily of tech firms. So how did you come to this topic of artificial intelligence? Is it around the companies and the opportunities, or is it more around what risks it can pose to existing Australian businesses?
Yeah, well, it's an interesting one, because I think opportunities versus risks, I think they're almost two sides of the same coin, right? So I think you got to look at it from both both angles. But as a start, why we're interested in AI is, as Damon said, we're long-term investors. So we're looking for companies that have competitive advantage, that have a long growth runway, that can compound their earnings for a decade. So when you're looking out that far, you have to look at different things that may impact trends, that may impact earnings and their ability to compound. So naturally, we've got to think about that a lot harder than those looking at sort of shorter term earnings trends. And tech shifts do have material impacts on companies' business models. Like the last one we went through with the cloud fundamentally changed a lot of things. Like it brought in the software as a service model and how customers bought, but also then how companies set up and how developers had to work together to improve their products and how the products got to customers. But the cloud was still a pretty seat-based model, right? You still bought a license and you still paid per person using the software. In AI, we think it could be a little bit different just because of the structure of the market. You have this inferencing coming through, which are going to impact companies' GP margins. And so they're looking to move towards more transactional-based pricing. So you got to think about how those models change the way value is created and then extracted by companies that we own. We own software companies as well. So I think it's important to understand from a risk perspective what factors are driving companies' current success you own, and then how that will change with introduction of new business models.
Yeah. And what do you think has sort of driven this recent acceleration in AI? I mean, machine learning techniques have been around for some time. Of course, we had the development of the cloud and more computer power, but why now, you reckon?
So you're not wrong in pointing out that machine learning has been around for a very long time and has been on a continuous improvement curve. I think the simplest answer as to why it feels like there's a sudden explosion is because of how ChatGPT consumerized what was happening behind the scenes and showed us all what was possible. But just taking one step back from that, I mean, what has happened in the last 3 or 4 years is that machine learning models have become very large. Large language models is LLMs in short, as you'd know. And there's a critical innovation that was invented by Google that allowed this to happen. So before Google invented or released their research paper on the transformer, the machine learning models were sort of hitting a learning plateau where you could put more parameters in and more data in, but the quality of the model wasn't improving. And researchers couldn't figure out why. Then effectively Google came out with the paper. I can't quite remember the name of it. It might be Attention is All You Need, but that was the concept of the transformer, which is when you would feed data into a model, it was a way in which the model could emphasize and de-emphasize certain words in a sentence. So it would give data that was fed in more contextual meaning. And with that applied, researchers started to see a more linear increase in data size or model size to quality of output. So then what that led to was a race to build bigger and bigger large language models. And then we get to a point in time where GPT 3.5 was released publicly. That forced all the hyperscalers to say, well, look, we're doing this behind the scenes as well. Look at what we're doing. And then the race was on to, go buy the most amount of GPUs from NVIDIA and start going into a hyperscale race for the smartest mass market models.
Yeah, and I think in some of the materials that we went through earlier as well, you talked about parallel processing. How is that affecting? So
parallel processing, it's not the invention that's led to where we are today. That goes right back to 2006, but it's a really important concept to understand. So parallel processing is the ability for GPUs to work in tandem. I think the simple way to explain it is that if you at the time ChatGPT was launched, if you tried to train ChatGPT on NVIDIA's fastest GPU at the time, it would have taken you 300 years. But by stitching together 1,024 GPUs, they were able to get the training time done in 34 days. That goes back to 2006 when NVIDIA released a software platform called CUDA, which gave software engineers the ability to get multiple GPUs to work together. And that is what effectively led to platforms of GPUs working to create bigger, smarter machines. So it's an important critical concept to understand when you think about hyperscale model training, but it's not a sudden invention that's happened lately to let us where we are.
So there's a lot of things coming together, but also sometimes when we talk about AI and machine learning, it's sort of addressed as one whole system. But there's of course many different elements of it. There's the search element, there's the chat function, there's summarization. So where do you think we will see the first practical use cases coming from AI in terms of companies that are doing interesting things?
Yeah, well, it's an interesting one because we're already starting to see some use cases. Obviously, we've got ChatGPT and then you've got co-pilots. But I think about if you in the medium term, the nearest term use cases have to have really strong ROIs to get a lot of traction. So if you think about the big cost buckets of an enterprise as the starting point, you've got sales and you've got R&D and administration. And I think those big buckets will be what the use cases in the early years will be about. So talking about efficiency and productivity, if you think about the sales team, for an example, you've got customer service chatbots that'll help the service team. You'll have personalised marketing and things like pipeline, propensity scoring and things like that, which will no doubt have immediate impacts on businesses enough to warrant the cost of implementing some of these things. And R&D, we're already seeing co-pilots coming, like GitHub Copilot is one in software engineering. And then if you think about healthcare companies, their R&D is more clinical trials. And so you can see plenty of use cases there. And then in administration, you've got back office automation. So we talk to a lot of companies and they seem to think that they can get their service level agreements, their SLAs down quite considerably by automating a lot of this unstructured data that they have to produce in the administration side. So, but when you think about how they'll roll out, I think you got to think about what a company is willing to pay for, that customers will end up being willing to pay for. And so you got to look at the kind of ROI on a use case by use case basis.
So do you see within sort of the companies that you hold within the portfolio, do you see any interesting applications there?
Yeah, I'll give you a good example. And I think that there will be commonalities when we think about corporate back offices, that the example I give applies to multiple companies, but then from a front office product perspective, it is going to be very case by case. So Hub24 is a business we're a big owner of and have been for a long time. They are a wealth platform that's used by financial advisors to administer client wealth. And as much as if you're a user of this wealth platform, it appears like magic, or the data is in the client interface ready for you, there is still a lot of manual work that happens in the background. If you think about managing your own private wealth, you get dividend statements mailed to you from fund managers and different holdings you may have. And when you have a financial advisors, those same statements are emailed or mailed to some sort of central office, back office for a wealth platform. And people have to open those letters, decide what information's in there, where it's relevant, and then do the manual uploads. And so as these businesses get bigger, or there's more clients sitting on a wealth platform, they need to hire more people. And CERM's talked about, they also have service level agreements where they promise the wealth advisor that if you go with our platform, we can get this data processed for you on an average within 7 days or something like that. So what Hub24 has been doing, and they've been building machine learning algorithms for nearly a decade, and we're starting to see the implementation of that, is they're optimizing that back office workflow. So just to put some concrete examples to this, they've turned, and this is just a general service you can buy with Aussie Post, but they've turned their mail house into a digital mail house. So all letters are basically scanned and then distributed to a certain email inbox. But the problem is that once you have that, all you have is an unstructured PDF document that is a picture of something that was previously mailed. You need machine learning algorithms, many of them, to not only read the unstructured data to make it readable by a machine, then to decide what it is. Is it a insurance form? Is it a fund manager statement? Is it a return statement? Is it a dividend statement? Is there a corporate action involved? And then you need to decide who that is relevant to, what data needs to be extracted, and where that needs to be put. So as Sam's already said, it's about structuring unstructured data that machine learning has made possible, and you need to have a lot of proprietary algorithms to be able to do that. There will be generalized algorithms that a hyperscaler can provide to you, like the ability to read a document, but then it becomes very industry specific to be able to train those algorithms to do the specific functions you need. So then Hub have taken those machine learning algorithms, applied robotic process automation to take the data from A and put it into B, if we're thinking about databases, and then you need a whole lot less people, perhaps to manage data inputs on a by exceptions basis. And suddenly you don't need to scale your back office costs with more clients. You have a much more scalable model and you can take cost out if you need to. And so that's an example of sort of back office workflow efficiency that machine learning will probably do for most companies. And then from a front office perspective, Hub serve advisors. Those advisors have their own administrative burdens and workflow to serve their clients. The best stat here is that the average advisor has about 100 clients or less. That implies about 2 clients a week, 2 client meetings a week in a given year. And, there should be a lot more client-facing time. But the reason that doesn't exist is because of all the administrative burden that goes with serving a client. And so Hub are thinking about how they can take what they've built for themselves and turn that into productivity enhancing software for their advisors. And they've publicly talked about some of the initiatives they've got together that we're really excited about. And I think this is going to go back to what we look for in businesses. And Sam's already sort of picked on this, but it's about finding businesses that are building competitive advantage with artificial intelligence. So in the wealth platform case, I can almost guarantee that most of the incumbents are barely talking about how artificial intelligence should be used in their existing companies in a proprietary sense. I'm sure they're all talking about Microsoft Copilot, GitHub Copilot, but when it comes to building proprietary algorithms, Hub's been on this journey for many years, and the incumbents are waking up. And so, we're excited about finding opportunities where we think that there's going to be a meaningful difference in the product proposition from the company we're invested in relative to all the people they're competing with, because that can fundamentally change the win rate of every RFP they go in for.
Yeah, that's an interesting one. The application as well to just documents and back office systems. Because I was thinking about it the other day. I used to be a journalist working in like a newswire, and so you would get a press release and you had to get it out in the next minute or so. And sometimes you would get a PDF and it was protected, so you could not copy and paste anything. You had to type everything out. So you had to type very fast. And nowadays you can just take a photo of it, ask ChatGPT to transcribe it for you. And within like 30 seconds, it's there, the whole thing. And that sort of changes, the dynamic for a lot of things, because these documents become readable and usable straight away. I think there's a couple of very interesting examples I've seen there. But often we think about these technologies and AI in particular as sort of disruptive. But at the same time, it seems it does take quite a lot of resources, does quite a lot of time and knowledge to implement this properly and get a competitive advantage out of it. Do you think that AI will simply confirm the dominance of larger companies, or will there be a disruptive element to it?
Yeah, so we actually think about this quite a lot, technology disruption in any business model. And I think when you think about what disruption actually is, we use Clayton Christensen's Innovator's Dilemma as a good roadmap for this. And really what technology disruption is when a new company comes along that's often targeting a pretty underserved part of the market. And while the incumbents are sitting there with great products but having to continue to develop and serve their current customer base, they can't change what they've already done, and when they're not serving that small customer, underserved customer as good as the new company coming along can. And then the kind of basis of competition changes over time as that smaller business gets better and better. And a good example of that is Xero and MYOB. So, Xero has been around now for a long time, but I still remember doing learning MYOB in university, and it was a great business. It serves their accountants and bookkeepers and small businesses really well. It had a great product, fully featured. And Xero came along and its product was nowhere near as good, right, for accountants and for small businesses. But it had 2 different unique features, and the cloud is the only thing that helped them do this. But they had a feature where it was a single file, so accountants could work on the same live file as what the small businesses did. And it also was pulling all your data from bank feeds. Now, those 2 things were great, but because they didn't have the same features, most people didn't really couldn't use it. But over time, Xero built more and more features up to the point where they were competing feature-rich products with MYOB, and then MYOB sitting there with an old monolithic kind of product that had to restructure. So that's kind of a really good example of what tech disruption can do and how hard it is to compete with that. with AI, I think it's the jury's still out, right? Because it's not the same as that, because what cloud did was allow smaller companies to scale up really quickly with the compute. In AI, so far, what we've seen is most of the investment's is happening with the big companies. It's very capital intensive innovation, and you need to have a lot of investment. So the big companies have been the ones that have been really investing behind this trend. So in the near term, it looks more confirmatory, sustaining kind of the competitive advantages that the existing companies have, as opposed to give smaller, newer companies the ability to compete with existing companies. So I think it's still out, but I think like most things, that's obvious to say now in the infancy of this phase. I think when you go 5, 10, 15 years down the track, you absolutely got to think that there's some new business models and new functionality that can be taken by smaller businesses and cause some disruption. So I think you need a framework, which goes back to how Damon described our business, but you need a framework to assess these things as they come along and to understand whether it's helping the existing investments you've got, or whether you really need to rethink, and whether the kind of the market's going a different direction.
Yeah. Now, disruption can sort of exist at multiple levels. So we talked a little bit about competitiveness, but I think initially when sort of ChatGPT came out, people were starting to worry, "Oh, I'm gonna lose my job," and then I think now the discussion is morphing more into, well, these things will not take somebody's job, but it will automate certain elements of their job or certain tasks. And the word AI agent has been bandied around a bit. What is your sense of that? Do you think that, especially within the Australian context, that we'll see job losses because of AI coming in? Or is it more things will become more, efficient and things will move faster?
Yeah, I think it's going to be a bit of both. And the best example of that would be, the rollout of the mainframe computer decades ago. A room full of bookkeepers doing journal entries in corporate offices don't exist anymore. They all lost their job. But it doesn't mean that the spreadsheet replaced the accountant. It just enhanced the productivity of the accountant, meaning that, some lost their jobs. I think there are going to be a lot of use cases where those jobs are lost. There will be jobs that could possibly be replaced entirely. But there are a lot of other places where when you enhance productivity and you make the access to tools a lot simpler, you can get an explosion in use cases. So a really good example that's up for debate and is unclear to me is you think about creative designers. They have to be trained on tools like Adobe to be able to do detailed content. And if we're thinking about video content, you actually need, much more training and specialist skills. Once, and Adobe are making some pretty impressive tracks with Gen AI, firstly from a, visual editing perspective and then in future with video to come. There's big debate. Is this going to mean that there are less creative designers in the world? And then what does that mean for the number of licenses that Adobe sell? Now, I don't think that's going to be an issue at all, because they will, be adding more value and they'll be able to have any price changes offset volume sales. But there's a school of thought that as soon as content creation becomes more accessible to more people and it can be personalized in a way that a different content proposition can be put forward to every consumer, you're going to need more content designers, and more people will be able to do that job because they don't need specialist training. They can talk to an interface and ask for, IP that previously they might have had to pay a consultant for. So, I think that there's going to be a bit of both is the shortest answer to your question, Rada.
Now, when we're talking about job losses, we're already venturing a little bit into what might be some of the dangers of AI. I think if we look at that, one of the things that stuck out for me is that there is more potential for fraud. You mentioned some of the video editing software, that there's the ability to more easily take on people's identities. It's an obvious one. But I think in some of the documentation that you gave me, you mentioned an interesting example as well around interaction with a chatbot. Is it possible to talk to a company's chatbot and actually get it to say more than it's supposed to tell you? Can you tell a little bit about that example?
Yeah, I mean, when you think about fraud vectors, there's going to be no change to, better tools to commit fraud and everyone else is playing catch up. I think what's going to be like the interesting dynamic here is, and this is a bigger conversation, but corporate use of machine learning models will be, in our view, a lot slower than what the hyperscalers would like. So they're doing a lot of investment right now, very expensive model training, and there's an expectation that corporate demand is going to follow and take up all these models and bring them internally. And there will be a degree of that. Like the Hub example is a good case, but all the other major platforms going to be as quick to progress what they're doing is, corporate apathy is going to be the first sort of hurdle to that. But then if you get past corporate apathy, you need to think about data governance. You need to think about your database structures. You can't just put all of your client data from 5 different databases together to do a machine learning model on top of it. There's a lot of factors that are going to take years for corporates to get right before that inferencing demand for machine learning models catches up to the extent that I think the hyperscalers are expecting. But specifically, I think that the use case you mentioned with the chatbot, that's a real example, right? So someone comes along with a service model that looks into the database that could theoretically, take away the need for physical people to look into your account, to answer questions about your account, maybe help you with your billing. Is it possible that that could be fooled into sharing too much personal information about it? Well, that's just going to be a question for boards, and that's going to make boards feel uncomfortable, and that's going to be something that really slows down how quick and willing they are to roll out these sorts of programs until they are 100% sure that there's not risk that they're introducing to their business model.
I think it's also an interesting part of the conversation that software companies are using almost as a negotiation technique. So if you think about everyone's fears around the trust of how do we trust these things, well, enterprises are saying you shouldn't. You should not trust these things. What you should do is trust your data with us, and then we'll put an OpenAI or whatever foundational model is the best at the time. We'll let your data interact with that, but we'll encrypt it on the way in and then decrypt it on the way out. So your data will never go anywhere near a large language model. So it won't know, in quotation marks, won't understand who or what the actual data is, but it'll get the outputs for you. So when you think about the tech stack that's going to offer this, just say you're paying Salesforce as an example $100 a seat, and for simplicity's sake, say that because of AI you can now charge $200 a seat. Now, who gets the extra $100 benefit from this? And you've got to think the whole tech stack, right? So you've got the fabs and TSMC, and you've got the fabulous guys like NVIDIA, and you've got the foundational models, and they're all going to have to take their pound of flesh and get their return on capital, and whoever has the best negotiating power in that stack is going to take most of the economics. And so when you think about foundational models, all the end services, the providers like all the enterprise software guys we talked about, Adobe and Salesforce, ServiceNow, all these guys, and similarly in the ASX market that implement these, they're finding ways to be able to pit them off against each other. So by separating the model, and saying we'll have the product and your data and be able to use that with the model, then we can switch them in and out. It effectively commoditizes them. So that gives them more pricing power. And of course, when you're close to the customer, you've got a bit more power as well. So I think it'll be really interesting to see how this plays out over time. At the moment, obviously, NVIDIA's got a lot of negotiating power and really reaping the rewards of that. In the longer term, it's going to be interesting to see what happens there.
Yeah. It's interesting that you mentioned that most boards don't really trust these systems yet. And I think there's a good reason for that, because there's this thing that we recently spoke about around AI hallucinations, where it basically makes up an answer if it doesn't have the data for it. But it also seems that when you ask it the same question, you often get like 3 or 4 different answers every time you ask it. So before it can be implemented, I think that there need to be a lot of structures put around it, because it potentially could give the wrong answer and have legal ramifications for that answer. So if you use it as a chatbot or a service provider as interacting with customers, and it gives you the wrong answer, there might be dangers around that as well.
Yeah, we even think about banks, right? So banks, you trying to use this data, they've got all this data, they use it in credit decision engines and all these things. Going and putting a model in there and getting answers around whether I should give you a mortgage or not as a bank, if you don't really understand exactly how that's being calculated, then you got serious problems. And then we talk about like the models that have been built on biased data, like they just understand the data from the raw data and have biases in there, and then you put that in there. So I think there's regulators like APRA are going to be very hesitant to allow people to do this. And you think about companies like Macquarie Group, that they absolutely know that AI is a massive trend and they have to be involved. They've got, their Macquarie Capital is going to be investing in a lot of these companies, but at the same time on the regulatory side, on the bank side, they're going to be very hesitant to be using any of this stuff in those kind of critical aspects of their business, I think.
Yeah, Wouter, I think the last and probably really important factor that slows corporates down that we haven't discussed is access to talent. So what we've learned from innovation leaders over time is that machine learning software engineers is a very different skill set to, your typical software engineer. Oftentimes they need to spend time learning themselves how to be hyper efficient. It's just a different way of operating and building logic. And that's a way of saying that it's not a mass market skill. It isn't like you've gone to university and studied machine learning and built up a huge base of knowledge workers that can go and execute. So the best talent is going to be scarce. And they're only going to want to work for the best companies, which is something we're all aware of for normal software engineers. So your typical corporate is not going to have any pull power to bring in in-house machine learning talent to actually apply it. So while everyone has a machine learning story, it's usually going to be the likes of something dressed up that's Microsoft Autopilot, or Copilot, I should say. And I think that one of the biggest winners in the next half decade or more is going to be consultants who get brought in by every boardroom and C-suite team saying, how can we bring machine learning in, and getting, charging enormous billable hours to outsource their own machine learning talent. But I think that's going to be a factor that slows down a lot of innovation outside of an existing few.
Yeah. I think Microsoft Autopilot will be the next version when everything
That's
is fully
exactly
automated.
Right. That's right.
What do you see as some of the more ethical considerations around AI, where it's not just outright fraud, but where you think, well, boards will have to make a call on this, particularly if you sort of look at it from an ESG perspective?
Yeah, I think the obvious one for large language model training is copyright. There are, unanswered questions in my mind around how ChatGPT trained itself on the entire internet and, doesn't have some sort of copyright questions that need to be answered. I think that's rather self-explanatory. Now, there will be some companies that push boundaries, but a lot of corporates don't want to end up in a legal circumstance because they've gone and used ChatGPT as part of their core offering, and ChatGPT itself was trained on data that wasn't actually theirs. Take contrast and go away from the written world of large language models into the Gen AI world of visual creative content. Think about Adobe. Adobe, lucky enough to have an enormous suite of stock content that they are, from my understanding, the legal owner of. It might not have been content that they originally procured themselves, but by it being part of Adobe stock, they have the licensing rights over it. And they trained Firefly, their Gen AI model, on this enormous stock of content. And so when they put that proposition forward to enterprises, use our AI content to create your own digital marketing media, the first question you'll get back from enterprises is, yeah, but what if it creates some sort of visual image that we later get sued for because it was ripping off someone else's IP and we didn't realize that? Like, we can't check every possible piece of input here. And Adobe have said, that's fine, we will indemnify you. We're so confident in our legal ownership position, we will indemnify you for any legal matters that come your way as a consequence of using Firefly to create digital media. And there are very few companies that are in that position. But generally speaking, copyright is going to be a major issue. And the second one would be training on customer data. Well, what is sensitive and proprietary to the client, and then that ends up in a machine learning model, and where does that data actually go and how is it used? All things that will slow boards down. Sam, anything that you'd call out?
No, that's other than obviously we'd already talked about the banking example. Like the outputs are going to matter. Like if you've got biased training data going in, you've got biased decision making coming out, and that can have serious consequences, especially when it comes to things like banks and who gets a mortgage and who doesn't.
Might not be an ethical consideration, but I think a bit of a business dilemma is, this came from a conversation. I won't name his name, but it was a Silicon Valley CEO that we met recently in person, and they made the point that with Copilot in software engineering, if you think of software engineers as 10 levels, 1 being your entry level, 10 being your 10x engineer who's just infinitely better than everybody else. The Copilot software that they've introduced internally immediately wipes out the majority of your need for the majority of your software engineers. So levels 1 to 6, your Copilot tools are better than them. And that's fine. You do that, but then you don't have levels 1 to 6 that are climbing the ranks. And so the trade-off is we could cut a lot of engineers here, but we're also going to cut a lot of future talent that could emerge as 7, 8, 9s and 10s on the quality ranks. And so I think that those sorts of ethical questions, but also business dilemmas that people will go through, because if the tool is years ahead of anyone can learn to be, and you don't need them anymore, how do you still create that pathway for people to learn who don't have the sort of traditional route of years of experience, because it's not needed anymore?
Yeah. That's an interesting example. Yeah. So we talked a lot about how AI might be used by companies. Have you guys played around with it yourself?
Look, every time I write the match report for my soccer team, I lean on ChatGPT just to give me some words of inspiration. But in a serious sense, from a professional setting, it can be quite a useful tool to extract insights. You can upload big, dense PDF documents and ask for it to find references to, very specific pieces that you're trying to research. And you can load multiple PDF documents and find me any comments that the company's made about guidance in the last 10 years. Find me changes that they made to their risks section over the last few years. And so you can start doing research in a more productive manner. But from a professional sense, I think that it's still very early days in tool development. We have a lot of conversations internally about how awesome it will be when artificial intelligence can help refine down the volume of content that we have to sift through to get to the best insights. It's not clear that we'd be anywhere near close on that.
Yeah, no, I agree. I'd even use it for YouTube videos. Like when you're researching an idea and you want to watch interviews of management teams or processes and how businesses are doing certain things, YouTube's a great asset, but it takes a long time. And even at 1.5, 2 times speed, it still takes a long time to get through some of that stuff. So as an efficiency tool, you use the ChatGPT plugin and you can get kind of great transcript summaries and tell you where to look. And I can say, I'm looking for this part, and I can get kind of get better answers or get to the answer quicker. And we're a funds management firm. We're effectively information processing firm. Like every day we're taking in more and more information through all of the people in our office, and we share it on Slack and we're sharing it to everyone. But there's so much information out there. I think the edge is never going to come from information, or even how efficient you can get at taking that information in. It's more around then your investment process and how you think about it, and what your time horizon is, and what you can, and your judgment around what matters more and what matters less.
Yeah. Now, I usually like to finish up with a little bit of crystal ball gazing. Where do you reckon that you will see the most change coming from in AI over the next couple of years? Let's say 3 to 5 years.
I reckon we've got different answers to this one, but I think that is a hard question to answer. If you go back to 2010, when the iPhone had been out a couple of years, and looked at the top 10 apps on the iPhone, Facebook was there. Like, you could have bought it 2 years later when it IPO'd, but Facebook was there. And then the kind of the other apps on that list were Words with Friends and the Weather Channel, and I can't even remember the others. But fast forward today and look at that list, and it's TikTok and Temu and Amazon and Netflix and Uber and Spotify, and the amount of value that those companies created versus ex-Facebook, the other companies on the list. What are we now? 14 years ago. It's going to be hard to imagine right now what those are, and I think that's the point is we don't need to, because we take them as they come through, and we can evaluate them as to how sustainable they are and how competitive they are. Damon?
Yeah, I think the trajectory forward is, hyper personalization of large language models. So if you think about a large language model today, it doesn't have a database, it doesn't have memory of its previous interactions with you, and it doesn't operate in a live manner. It doesn't draw from the internet per se. So effectively, you have to give it prompts every time you want to use it to do a very specific thing. And no one's really figured out yet, and I'm sure they're all the hyperscalers are trying, but how to make them mass personalized. So you can imagine having an LLM that's worked with Wouter for the last 5 years, that has deep insights to everything in your OneNote or your Evernote, has like a second brain for you, doesn't need to be prompted by you, knows how you write, what mistakes you make.
Start speaking Dutch.
Yeah, and can sort of be a bit of a co-pilot, a personalized co-pilot for you. And so when I'm coming for a meeting with my next company that I'm going to go meet with, I can say, tell me find all the insights that this management team has told me about how they're changing their cost base, and give me some good questions that I might not have yet thought to ask, or something very specific to me. Obviously, LLMs are very generalized at the moment, and it's very hard to have personalization at scale. But I think that's the path that everyone's trying to head down, and that itself unlocks use cases that are, it'd be very even hard to brainstorm about today. But that's where the true innovation is going to come from, in my view.
Yeah, that makes sense. That would be very interesting. Well, Damon, Sam, thank you very much for coming in today. Much appreciated.
Thanks, Wouter.
Thanks, Wouter. Thanks for your time.
Thank you for listening to the i3 podcast. For more information, please visit www.i3-invest.com. Thank you very much.